If you have been watching this week's shorts, you already know that direct and regular mutual funds invest in the same underlying portfolio. The key difference is cost. Today, in just 3 minutes, I will show you how direct funds can improve long-term returns, what to watch out for before switching, and how to make the transition correctly. Let's begin. Regular mutual funds include distributor commissions within their expense ratio. Direct funds do not. As a result, direct funds typically have a lower expense ratio. Now, a difference of even 1% per year may not sound like much, but over 20 or 25 years, that small difference can compound into several lakhs of rupees. Because direct funds have lower expenses, their NAV is generally higher than the regular version of the same scheme. Over time, this gap widens, and when you calculate your actual annualized return using XIRR, you will often see the impact of those higher costs. But don't rush to switch everything immediately. Before making any changes, check 3 things: your holding period, any applicable exit load, and the potential tax impact. That is because moving from a regular fund to a direct fund is generally treated as a redemption followed by a fresh purchase. This brings us to the 2 key checkpoints. First, exit loads. Many equity funds charge an exit load if units are redeemed within a specified period, often 365 days. Always check your scheme details before redeeming. Second, capital gains tax. Since the transaction is treated as a sale, taxes may apply on any gains. For equity funds, gains on units held for less than 1 year are generally taxed as short-term capital gains. Units held longer than 1 year generally qualify for long-term capital gains taxation. So what should you do? For existing investments, evaluate the tax and exit load impact before switching. For your ongoing SIPs, consider moving future contributions to direct funds as early as possible so that new money starts benefiting from lower costs immediately. You can invest in direct funds either through the mutual fund company's official website or through platforms that offer direct mutual fund plans. Remember, direct funds don't guarantee higher market returns. They simply reduce costs, and lower costs can make a meaningful difference over the long term. If you found this masterclass useful, subscribe for next week's topic and share this video with someone who is building a portfolio. See you next week with a fresh topic. Disclaimer: this video is for investor education and awareness purposes only.